Welcome to Dividend Talk, podcast episode 6. Let's talk about second quarter earnings. Yo! Welcome back to another great Dividend Show! I'm your co-host European DJI, and as always I'm joined today with Engineer My Freedom. In this episode we are joined by John, also known as TheMoneyPersuit. Today we really want to talk about the second quarterly earnings with you. Several great dividend stocks reported out last week, so we thought that it's about time to see how they've been doing during these extraordinary times. Besides this, we'll also look at some of the news, answer a few of your questions and provide our stock picks of the week. So as you can hear, lots of stocks are passing by today, and that all with our own European flavor. We are delighted that you could join us today, and if you're new, please hit the like button and subscribe to us. It will really help the YouTube algorithm. Feel also free to check out our previous episodes on YouTube and Spotify and all of your other favorite platforms. See you in the inside! So let's get started. Hey John, how are you doing?
Hey guys, I'm doing well, thanks. Thanks for the opportunity to chat with you.
So I think our listeners might not know you yet. Would you be able to introduce yourself a bit to us?
Yeah, sure. So I'm John. My Twitter handle is TheMoneyPersuit. I'm in South Africa, Cape Town specifically. I'm primarily finding my way through dividend growth investing and learning and sharing as I go. So as I said, primarily investing in the US. We have kind of limited access to markets across the globe, but with the US being one of the biggest ones or the biggest one, I just felt like I was missing out if I'm not investing in there directly. So thankful that I can, and the market is massive, and I do enjoy reading up on financials and learning as I go. So I swallow up all my free time essentially.
Have you been investing long? How long have you been on this journey?
So I started out in 2013. I started out with mutual funds, and after a while learned about ETFs, which is a very big difference in the costs at least. So I went down the whole ETF path and figured out that mutual funds are maybe not the best thing for me. And I started doing a bit of DIY investing in around 2014 with ETFs. And it didn't take long to jump ship from ETFs to individual shares, because I guess we all like the sound of that. So I started that in 2015 about. And since then, I only started investing in the US about halfway through 2018 when we got access to the market quite easily. Yeah, from there it's been going.
It's great to have you here. We also know that you wrote some books, and I would just encourage everyone to check out your Twitter profile and to see what you've been writing about. But to get to know you a little bit better, we have also prepared some questions for you. So the idea is we propose you 6 statements, and you get to choose, and then afterwards you have the opportunity to clarify on 2 of those. Are you ready for it? For some of these rapid fire questions?
I have to be, I guess.
Good. So let's get started. First question: Tesla or realty income?
Realty income.
Cool. Second question: you will get $5 million as a lump sum, or you get $25,000 every month for the rest of your life?
No, I'll do the 5 million easy.
Cool. Third question: cigarettes or oil?
Cigarettes.
Fourth question: social welfare or universal basic income?
Ooh, tough one. I'll say social welfare, I guess.
Nice. The fifth one: winning the World Cup soccer with South Africa or being president of the entire world for a full year?
Oh, I think it's dangerous for me to be president. So I'll have to take soccer.
And then the last one. Do you drink whiskey with ice or without?
No, need always.
So is there something you would like to clarify from your answers?
Yeah, I think the 5 million one is always an interesting question. I've seen it been asked before sometimes, and I find it interesting that people would opt for a lower steady income. I guess it just removes a whole lot of effort you have to put in. But then with 5 million, I'm pretty sure if you invest it wisely, as we do or try to, you could easily outperform that number per month. So that was an easy one. And then Tesla Realty Income. Tesla is for me such an interesting thing to see play out, especially recently. But my risk tolerance is way too low for Tesla. So I prefer a real estate based thing, something that's tangible and I can see and touch. It just makes a whole lot more sense for me.
Cool.
Yeah, I'd have to agree on both of those. I definitely snap the hand off 5 million up front rather than slow and steady. Like you, if you invested, I'd probably blow about 1 million of it, to be fair, up front, just sports cars and houses, just because I can. But I definitely take that. And with Tesla and Realty Income, I'd be of the exact same mindset. Maybe that's why we're dividend growth investors, lower risk. Don't need to be worrying about it going up too high or too low.
I would for sure buy a Tesla for the 5 million.
Oh, of course. Of course.
Okay, so it's great to get to know you a little bit like this, John. So let's start with our first section then for today. So, Derek, is there anything that interested you today in the news?
Yeah, there was a couple of things that I seen. So the first one was Chevron. They bought Noble Energy. So I believe we're going to start seeing a lot of this happening. With energy stocks, they're going to start buying companies that are cheap now and the price has gone down. So I'm expecting to see a few more of those. And the second thing that kind of popped out to me just before I came on here was it was American Express. I think their earnings were down 85% or something on last year, which is ridiculous. And I'm kind of wondering, not so much about American Express, but I'm thinking towards Visa. I think their earnings is out next week. So I'm kind of wondering, is that going to follow through? Are they going to see the same level of drop and how that's going to affect them? So they were the two real pieces of information I've seen. Other than that, I was kind of stuck in earnings reports all week. So the news is on the back burner. But the Visa one next week will definitely be one I'll be watching.
So, you know that I've got a really simple view on that, and that might sound awkward, specifically to our listeners across the pond. I think just the fact that it has America in the name is already an issue for many European people because it alienates a little bit people when they need to choose between Visa and American Express. For me, American Express is still printed in my head like checks, traveler checks that you used.
Yeah.
And Visa for me sounds much more neutral and more modern. And I don't know where this comes from, but it is branded, and I've got this strong picture in my head. And I can imagine that this is in general impacting the slow growth that American Express is seeing.
Yeah, it's funny you say that because I'd have that same vision, and it's almost like like you said, a check style, an old style system. And if I was thinking of a credit card, it's MasterCard or Visa.
Yeah.
American Express doesn't translate, but maybe it's different for our American investors. Maybe they think American Express first, then Visa, then MasterCard. So it'll still be interesting to see if it translates across the board. It'll be definitely one to watch. And how about you? Did you see anything in the news this week?
So my news for the week was that our, really knowledgeable leaders, European leaders, agreed on a budget. So they're going to burn 1.8 billion over the upcoming years, of which 750 billion is reserved for the coronavirus relief fund. So I think this extraordinary that they were able to achieve this. I know that the European Parliament didn't agree actually to it fully yet. I read it in the news today. I know there is some fuss between North and southern countries in this, but I would just say, like, if everyone keeps their head cool, we haven't had a war since the Second World War, due to also the European Union. There are some countries in need, and I trust on them having at least a proper conversation and to listen to each other, to understand and not to be understood. Then I'm sure we'll figure things out. But it's for me a big thing, a really big thing.
Yeah, I'd agree with you. I mean, we're all Europeans at the end of the day, and there are some countries that do need help, and are fellow Europeans that do. So, look, I'm happy that this has gone through, nearly gone through, at least agreed in principle. There's some areas that I'm unsure of, but I don't have all the facts at the moment. But it's just good to see the European Union as a bloc coming together and being able to trash out that deal, and hopefully just makes the union stronger, and we can keep moving forward.
John, anything from your side in the news?
I think I'm going to touch on Tesla again. It's such an interesting thing. And I told Derek before, I saw an article where they said it might be included in the S&P 500 sometime. So just thinking of what that would mean for price movement. If you have all these ETFs and funds and everything that tracks the S&P index, I'm assuming they would be forced to buy Tesla shares if they were to be added. And what would that do to the share price that has already run so hard? It's such a fascinating thing to see play out. I'm not sure when they would decide whether it's added or not. But yeah, definitely interesting.
Well, I think that's something that we've seen before, John. I think that a lot of the algorithms and the index funds are currently dominating a lot of the purchasing or the selling in the market. So there will be a lot of new influx in money. Personally, I'm not owning Tesla. I'm not considering to own Tesla. So for me, it's not so much of interest, but I can understand if you want to make a quick buck by, for instance, thinking that it will grow 4 to 5% overnight. Might be a nice speculative play. That's more how I see it with these kinds of things. But then I would probably first look at past companies that joined the S&P 500 and see what it did to them. I remember GE going out of the Dow Jones, brought GE a little bit more down again, but I have not enough data to understand that. But yeah,
that's a good way of looking at how it will affect the index. And as you said, it's sort of a self-fulfilling prophecy. They get added into the S&P 500, and then more people buy, and they're buying more shares of Tesla. They go up, and it's just kind of propelling itself up. But like you said, it's, for me, I can't get involved. It would be speculative, and I can guarantee you, if I was to buy that right now, it would drop 5% straight away. So it's not something that I could get into.
That's the engineer my freedom karma. I'll share some of my karma with you, but it will go even more down then. Okay, cool. So a lot was happening again this week, as we saw. So let's get started on our next topic, our main topic for today. And today we would like to reflect on the earnings from last week, because I think what is really interesting, that this was probably one of the most extraordinary earnings quarters that I've lived through in my life. I remember still the 2008 crash, but something like this lockdown, the massive loss of jobs, I've never seen that in my life. So I was really curious about the earnings. And so today we will touch upon few companies, typical dividend stocks, and check how they've been performing. So Engineer My Freedom, which company did you check in on this week regarding the earnings?
The company I checked in originally was IBM, for two reasons. One, I have them in my portfolio. And the second reason, which I mentioned to you, was my friend actually works for them. She works for Red Hat. She loves Red Hat and is always talking about it. So it's good to for me to talk to her about this and maybe get her interested in this kind of area. But I was quite surprised. They initially, if you gloss over the earnings, it looks like a very positive review. Some things that stood out to me was Red Hat. Red Hat, they were up 17% in revenue growth, which is pretty good. Their cloud strength seems to be going, their cloud business seems to be going from strength to strength. So that was up 33%. their EPS, diluted EPS, beat expectation by 1.87%, which is always good. And most of their revenue is recurring, so that's positive. And as an investor, those things look good on paper. But if you look at the rest of the business, there wasn't a whole lot of good news. Everything else was down. There's no growth in any of the global business. It's really the cloud business and Red Hat that seem to be propping it up at the moment. They've got a high yield. It's 5.21%. Their cash flow seems to be fine. I think free cash flow this quarter was 2.3 billion. So that's a 65% payout ratio, which is good. But overall, I'm a little bit worried about how the old business is going and their consulting. And I think the new CEO went in there at the start of the year, and maybe because of COVID, it's a pretty bad time to go in and try to take over a company and try grow. So you probably have to give him a chance. We haven't seen anything of note, any changes, or what his progress, what's he thinking for the future. He's kind of just come in and took over from where the last guy left off. So for me, I would probably avoid adding to them. It's encouraging with Red Hat, it's encouraging with the cloud, as I said, but I just can't find a case for him to add any more shares to my portfolio.
And have you been able to look a little bit into the, let's say, the share of revenue for their cloud business and Red Hat? Any interesting observations there?
So Red Hat is included in what's called a cloud and cognitive areas, and that generates 5.7 billion overall, and Red Hat contributed just over 1 billion of that. So that's roughly 20% of that. It is roughly 6% of the overall business, which is not bad, but it's growing. I reckon in about maybe 7 to 8 years, it might take over a large chunk of that business if it grows at the rate that it's 17% every year, which it may or may not. But certainly the cloud and cognitive area is probably where they're going to be making their money going forward. The consulting business doesn't seem to be where it should be or where I'd like it to be. So Red Hat is a pretty big gamble, and I have a really interested in Red Hat. As I said, my friends there, but they've opened up an office. If you look out my window, I could see their office from here. They employ a lot of people in my area, so it would be nice to see them do well from that perspective. But also because I have them in my portfolio, I would like the other areas to catch up to the growth that Red Hat has.
I guess we're all hoping a little bit that it might become the next Microsoft, right? For decades.
Yeah, but it's hard to see that happening, but it is the hope.
Yeah. Okay. Cool. Interesting one. I'm really looking forward to see how IBM will be doing. And for me, it is really because I've been looking into this company so often, and I never pulled the trigger for the reasons actually you just mentioned. And for me, I would like to see the CEO. I don't see any mojo in this person at the moment. He comes really across like another corporate, and there's no. He doesn't even smile. I think when I see his videos, I don't see passion there, and that's what I'm missing. So unless he doesn't start speaking with the numbers by showing just revenue increase, I will probably stay away from it for now.
Yeah, but just to give him a little bit of credit, he's got in at a really difficult time. Anybody going in this period would probably struggle. But like you, I'm not quite seeing his direction, or I feel like he's just taken over what was there and just left it. I haven't seen him push anything forward. So
we should not forget that the last quarter was the opportunity for cloud businesses to knock everyone out of the park. This was the moment to get your feet between the doors.
Yeah,
cool. Hey John, EMF had a nice one. IBM. How about you? Which was the company that you have been looking at when it comes to the Q2 earnings?
So a few interest me, but I only own one that is reporting, which is AT&T. It's like a bond-like stock almost, with the dividends being consistent, but it doesn't seem that they're growing at the rate of knots. But the other ones that I found really interesting is Microsoft and Intel today. So firstly, with Microsoft, I mean, they have a great cloud business and they're growing well. Revenue up, everything is up. But what I found odd with, so they beat the earnings per share by 9 cents. The revenue beat also by 1.5 billion almost. Their revenue is up 12.8% year on year. So, I mean, all good numbers from what I would gather. But the interesting bit was the share price reaction was they were actually down 2.2% at that point, which, I mean, could be market moves, but it feels like in this market, when you beat something, you either have to beat it to death in a sense, like a real big beat, or if you dare to miss anything, like Intel today, you will be punished quite harshly. So I don't own either directly, but it's a very interesting thing just to see it play out. Intel being down 15% in a day is harsh. I get the delay in a certain new chip size that they put out. But it feels like this market doesn't take any prisoners.
I think so maybe first about Microsoft. I found it really interesting to see that if you really looked at the revenue segments, because they have 3 business units, right? It was really, really interesting to see that their intelligent cloud now, I think for the first time, if you really look at the full year, was the biggest business unit in the company. And it was growing with 17%, like you mentioned.
Yeah.
So they're now at the stage that the cloud is the biggest business driver. And that's really interesting because this means that more and more of the growth will flow quickly to the bottom line. So I think because in the past, if you look at the EPS, it has been growing quite steadily, but not in the same numbers as the cloud business was growing, right? So I think now in the upcoming future, if they keep hitting these numbers, I think we will see an uptake in EPS. But I guess the market was expecting a little bit more there. But for me, Microsoft is an example of a company that is really growing rapidly, and yeah, I don't look too much at the price at the moment. It's my largest position in my portfolio, but I would be fine if it would lose half of the value because I would be a buyer at $100 per share.
No, most definitely. It's definitely one of those that has gotten away over and over and over for me in time.
Yeah, and then Intel, I think they deserve this beating because I know a little bit about this space, and this is such a competitive space, and AMD is producing these chips already, right? So for me, Intel is still a 5G play. It's also how you say it? Which was it again? Okay, never mind. But not being in that business of these new 7 nanometer chips, I think they're losing an opportunity there. And then that's why I think you see them being punished. And I wouldn't be surprised if the stock tanks even more to the low 40s in the upcoming days. And maybe then I might start thinking about it as a value play. But I'm so disappointed in this company that they can't even get their innovation straight there. Yeah, on one of the most important projects for the whole company, which is on the critical path, in my opinion, is like it shows just at the moment the lack of competence in this area, I guess.
Yeah, it's very interesting to see over time. I've followed AMD and Intel just by using their products for many years, and AMD was for a long time kind of behind in a sense. It always fell short a little bit performance-wise and so on. But it's interesting to see how it looks like they're playing catch-up in a sense and surpassing them even to some extent.
What does your mind say, John? Jump on AMD, which is of course highly valued and high growth, or jump on Intel, which has some setbacks but has nice numbers from a dividend investing point of view?
My first thought would be Intel, Because if I still think if you buy a laptop or whatever, the odds is that you'd have Intel chips in there, at least in our country. Intel is by far the most widely available one. I'm actually not 100% sure worldwide, but I think Intel is much bigger than AMD. So that's a pro and a con, sure. But then also my allergic to reaction to high valuations and prices almost by default make Intel the buy for me between the two. Because I mean, I've discussed it with Derek before sometimes, where if a good big business makes a mistake, I quite believe that they won't go and just sit back and take it forever.
Yeah.
They'll be on the back foot for a while, but I would be very surprised if they just, if they never get their mojo back.
Yeah.
And that's where the value lies, isn't it?
Exactly.
For us as dividend growth investors, we want them to make the odd mistake. We want them to come down in price. Intel, if it hit $40, you would snap them up. Of course you would. I mean, why wouldn't
probably
you?
I would as well, yeah.
So I'd agree. They should be punished. I mean, it's incredible how they haven't got this in order, and AMD will benefit in the short to medium term. But they are a 5G play as well, and that could change a whole lot soon. So I hope they do drop. If they do drop, definitely to 40s, I will be buying. If they drop to 50s, I will consider buying them. So it's more a value play for me. But like you said, if they're a big company, I can't see them sitting back and letting this happen.
Very interesting. So thanks, John. So I will give a little bit of a European flavor then today regarding the earnings. I've been looking at Unilever. It's one of those companies which is one of the biggest holdings. I talk a lot about it typically because it's for me a role model company in Europe, specifically as a dividend grow company. Although you might argue that their dividend is not growing this year because this is the second quarter in a row that they are maintaining their dividend. And I actually heard on the news, on the radio, that they were saying, they announced it as Unilever didn't cut their dividend yet. And I felt like, come on, I studied their 100-year history. They have one time cut their dividend since the Second World War with one bloody cent because there was a CEO probably not paying attention, watching at the left while he should have looked at the right. And for the rest, it has multiple times it has just maintained the dividend. And I believe as well during the financial crisis. And I think it's almost like their crisis playbook. Leverage a little bit up till the next crisis, then use the crisis as an argument to maintain your dividend, clean up your balance sheet a bit again so that you're prepared for the next bull market. So this is for me totally in the Unilever playbook to maintain the dividend. And I'm totally fine with that because as a dividend investor, I don't want to see a drop on income, and my average portfolio should increase. So I'm not so attached to one company maintaining the dividend. But what I liked about this year is that their sales were effectively flat, literally 0.1% down, I think 0.3% on volume, 0.2% up when it comes due to price increases. So that makes it 0.1 minus. I mean, what are we talking about here? The interesting thing here from a business point of view is that they are going to, to separate the tea business. And I believe Lipton is one of those big products that probably most of us know. And John, interesting for you as well, because I think a lot of the tea comes from South Africa. And
we have Rooibos here, which is also quite a well-known one.
So they believe that the tea business would be better off alone. So maybe they will do some acquisitions in your region. Who knows? But they want to do that by the end of 2021. I don't know whether they will do a spin-off so that we get as shareholders also a part of this new company, or whether they will just use this money to purchase other companies. I don't know yet. I couldn't find any information in it. And then when you look at the small letters in the earnings report, what I found really interesting is the reason why Unilever sales were flat was because of America. Because in Q2, American sales were up 9.2%, while everywhere else around the globe they were down 5-6%. And the reason is stockpiling in America. And we have seen all those videos, I think, with people standing in the queue in front of the Walmarts. And Unilever was a big beneficiary of that. So, Russ, if you're listening in Chicago, thank you for stockpiling. It saved my dividends. If you then look at the earnings per share, it was 1.25. These are the non-GAAP, the GAAP earnings. I always prefer to talk in GAAP earnings, but I know that it makes it a little bit harder to compare with last year. So if you want to take their current EPS, it was on 140, and this was an increase of 9% compared to last year. What I also liked was their free cash flow. It was 2.9 billion, and last year it was 1.5 billion. And this is interesting. And also Burswolf mentioned that, but what you will see with these companies that have a good business and a defensive business, you will see that typically their cash flow is much higher because they just start cost saving as well. So to preserve cash, but actually they almost doubled their cash compared to last year. So you can imagine a corporate like Unilever, offices all around the world. Those offices didn't have the light turned on. Probably they delayed paying some of the bills or the way around, and this just beefs up their working capital. So hence why they had more cash flow coming in. What was also interesting to see was that the e-commerce business, or like selling via online sales, grew with 62%. And of course, this is not like a surprise as such during a lockdown, but it's now already 8% of their total sales going via online channels. And that I found really interesting, because if I think about Unilever products, I actually buy them every day in a shop. I never buy them online. So it was interesting to see that we're already getting up to 10%. And again, here the USA was the leader because they had a online sales increase of 177%, which is and what I know, what I've learned is that if America starts moving to online, usually Europe follows 1 or 2 years later. So I wouldn't be surprised if our behavior here in this podcast will also change in 1 to 2 years from now by other online platforms.
But maybe that's one to keep an eye on that trend in the next quarter as the lockdowns ease and as people can move around. Will that revenue still be that high, or will there be a dramatic drop? Will people go back to normal? I suppose is what I would be thinking. At the moment, it makes sense. Everybody was stuck in their house. You couldn't really go outside the door, so it makes sense to buy stuff online and stuff that you need. And of course, their online business is going to increase. But if it's going to continue being a trend, I'm not so sure. I would have, if you had asked me mid-lockdown, I would have said yes. There's no way people would go back to normal. But I just look at what's happening outside my door, and people have gone back to normal. They flock to shops, they're flocking to beaches, their buying habits stay the same. So I'm not so sure people will continue buying online. They will increase, obviously, with the younger generation. It'll increase with that generation, but my generation, I believe they'll just go back to normal and go down to the shop. I'm not sure it'll continue as lockdown.
From a Unilever point of view, I feel totally comfortable because, for instance, their out-of-home ice cream decreased and their ice cream itself that you buy in the shop increased. So there's like really a hedge in their portfolio when it comes to stay at home versus eating in the restaurants outside. And I liked it. It was a nice reflection on the quarterly 2 earnings. There are many more stocks that we could have discussed, of course. So maybe we should do another round next week. Let's think about it. So we also got a few listener questions for today. And the first one is from the person with the last difficult last name, Salin Churario. And he would like to know your opinion on Tesla's sale of carbon and environmental credits.
Yeah, we spoke briefly about this just before we came on. It's not something that I think we agreed it's not our area of expertise, and I wasn't aware of even Tesla doing this. I do have some knowledge of this happening in the energy space within Europe. So coming up, it's 2020 now, but coming up to the 2020 and 2030 plan that was in Europe, countries could sell their credits to other countries. So if you had a net carbon emission, you could sell your credits to a country that had pretty bad carbon emissions. And I suppose my opinion on it is I'm not totally against it, to be honest with you. I suppose I'm not. I don't know. Like, I do like the whole idea of energy efficient and reducing carbon, but I'm not proactively out there advertising this. So I don't see an issue in this. If a company has got a net carbon and they want to sell it to another company, why should they not capitalize on that and make money on that? I'm not against it anyway. I'd love to hear your thoughts, John, or EDGI, but personally I would not be against it at all.
Same here. Nothing to add from my side.
Yeah, I think we're in agreement. I agree that I'm a capitalist fan. So if you can create a business from something, go ahead and do it.
Yeah.
Okay, then. So we have the second question, and it's from Raffinger. As an Italian buying a US stock, I should pay 15% for the US dividend tax plus 26% as double taxation. Similar for European countries. I'm still confused if compounding and accumulation would be more convenient.
Yeah, I was looking at this question and I kind of went back to him on Twitter. I was a little bit confused. I just want to say I'm not a taxation expert in my own country, let alone in Italy. But it does seem quite high. 41%, you're paying your 15% withholding tax and 26% on top is quite high and not the European norm, I would imagine. Paying that amount of tax, I don't know. I would probably look at more efficient ways within your country to invest. I'm sure there is. There's always tax advantage ways. Can you invest through a tax advantage pension account, for example? Or I'm not too sure of the Italian system, as I said, but if I was paying that amount of tax on single shares all the time, I would have to consider other options.
So I'm neither a fiscal specialist here, so I would definitely advise him to just pay one time $100 to an Italian accountant or specialist and get this sorted. It might save Raffinger might save you a lot of money. In general, how it works for me is the Giro and such. They already withhold the dividend tax for me. And then there's a slight difference, and I just pay the difference at the moment because that's my understanding from the double taxation treaty between the countries, and that's effectively what I'm doing. So my dividend tax is never more than 19%, unless I'm investing in France, Switzerland, or Germany. And in this case, I'm going next year to ask my money back effectively by doing it myself. And so I think it might be the case that in the worst case, Raffinger wouldn't pay more than 26%. But the double taxation treaties are often quite clear about that you should not tax more than 15%. It's just usually that the systems that we're using at our banks are not properly set up for that. And I'm always doubting then, should I then still, in his case, pay the additional 11%, but I would never pay the additional 26%. Then they will probably see me up in court if I would be wrong, but I will not do it voluntary.
Yeah. But usually, and with the Giro, and you touched on this, they look after the withholding tax for us. Yeah. But there's usually a WB10 form, or there's usually a form that you fill out.
And W8, yeah.
And it's all done for you. So maybe check your broker. I'm not sure what broker you're using. I would have thought that you're paying a maximum of 26%, which would be your level of income tax in your country. I find it hard to believe you're paying 41% over. It's maybe you are, but I find that hard comparing it to other European countries, I suppose.
Well, the good thing is one day we will have a tax advisor here in this show that will explain us everything. So stay tuned. Well, the last question then from Bullish Bear. In the USA, it seems like things are going from bad to worse and the recession is more than likely. Are you going to sell some stocks in order to get more liquidity and buy stocks more at a lower price back?
John, I'll let you take the reins on this one.
So my short answer would be no, because I am beyond terrible at trying to time the market. I rely on my dividends to keep showing up regularly, so I get to reinvest. Hopefully, the prices are a bit lower. But if I would sell something in anticipation of, I would probably still not own any stocks after March. So I just keep my head down and I keep going.
I believe that's the mantra for dividend growth investor, isn't it? Just
Yes.
don't sell. I don't buy stocks to sell. I really don't. I don't really look at prices a whole lot. It's not relevant to me. They could go down, and yes, I could make extra money, but there's other ways to make money from that. And EDGI wrote a brilliant blog post recently about options, for example, that you can capitalize on stuff like this. So there's always ways to maximize your money, but selling is not an option for me. And like you, if I sold, the price would probably just shoot up anyway. So
We just spoke about taxes. Don't forget about the capital gains tax. If I would now need to pay capital gains tax on my Microsoft holdings, which are up fourfold, I don't want to pay that. So
yeah,
that's also one of the reasons. Great.
very good questions again, guys. Thanks a million for all the questions. We do like them. Very little preparation today. We literally asked them the last minute, so it's good to get these questions and try and answer them best we can.
So now we get actually towards our, I think, most interesting at times part of the podcast, and that's the stock pick of the week. And as we have a guest today, John, would you like to be the first and share us your stock pick of the week?
Yeah, sure. So I quite like Broadcom, ticker code AVGO, a chipset manufacturer and a semiconductor manufacturer. And they're also in a 5G play. They're actually competition for Intel, if I'm not mistaken, to some extent. I'm curious to see what 5G would do for them. They have a very nice yield still. Currently, it's about 4.2%, which is quite high for a business that I think could benefit in a sense from tech overall. And they've been having a massive dividend growth streak the last few years. I think the 5-year average is sitting at something like 55%, which is extremely high. I don't expect them to keep going at that rate. But I think the last increase was still 16%, which is, I think, is a really good, strong number. So yeah, I do like them being close enough to the tech space, but not being as expensive at all. We rarely use price earnings, but the PE is at 14, which I think is quite reasonable. I'm hoping that this is one of the shares that continue to increase that dividend over a long time and can really show the power of that dividend growth investing.
Interesting. It's not a company I've considered before, so I'm definitely going to check them out.
Yeah, I think I also stumbled upon them some time ago. I'm actually not sure. I haven't owned it for that long. It's maybe 7 or 8 months. But definitely an interesting play. Everyone's talking about 5G this and 5G that. And they actually supply a whole bunch of components to Apple. In fact, I think, if I'm not mistaken, Apple is their biggest customer for a certain business section, which I guess is also a big risk. If Apple decides to buy their chips from someone else, it would definitely have a very big impact on them. But I'm not sure how often you switch chip suppliers. So I wouldn't be too concerned about it right now.
I'm just wondering a little bit about 5G myself, and I'm totally not competent in this area, but I'm just thinking sometimes, I mean, I hear Elon Musk shooting satellites into space together with Jeff Bezos, like if it's like New Year's Eve. Yeah. and I'm just wondering, like, will 5G or something like that not just become obsolete? What if what if they come with something clever that we just get a satellite connection? Why would we need all these all these 5G, 4G everywhere around us? So probably it shows you that I'm incompetent, but this is usually the thought that I have in my head in this in this space.
But isn't that how technology usually works? They have it developed. They're already developing what's next while they're rolling out the next best thing. So they're always one step ahead. At least that's what I'm led to believe. So maybe there is something better.
Yeah, I mean, it ties in a little bit to everyone talking about it at AT&T, where they would benefit this much and that much from 5G. And I'm actually not sure how much people will change their usage patterns because you have a faster connectivity. So I'm not totally convinced in that sense, but I've been wrong most times. So
perfect. Okay, EDGI, it's your turn. Who's your stock pick of the week?
I'm going for a really nice, boring company today, which is Realty Income. I initiated a position not that long ago, and I was just going through my, desired portfolio again. I was just checking out some companies, and I saw like, oh, wait a second, Realty Income is nearing my value zone again. So for me, it's a company that I would just like to accumulate every time it dips below $55. It's now around 57 and few cents. So if we would see a little bit more of this pullback that we're seeing the last 2 days, then hopefully I'm buying it next week. So I've got a price order outstanding for $55, and it currently gives like a 4.7% yield. I think this is what Realty Income is about. It's a dividend play, nothing more, nothing less. I do see when I go through their reports that like 20% of their portfolio is at high risk due to COVID-19. I personally don't believe they will lose 20% of that whole portfolio, like it will be disappear overnight. But I do expect some impact there. But I think that's also the reason why the price is down from where it was before, because we should remember that this is still a low interest environment. So real estate investment trust prices are in general inflated because of that. So for me, therefore, this is a really good company to add now to my portfolio.
Mm-hmm. We love boring dividend companies here, don't we?
But definitely.
They're like clockwork. If it was I don't know how many dividend increases they have, but I joke with John all the time on Twitter, and we always say monthly paying stocks. It's just nice, isn't it? You wish all companies paid you monthly. It's just nice to get that dividend.
Yeah.
And like you, I added some this month. It was more of a dividend reinvestment for me. So, as you know, the Gyro doesn't automatically reinvest your dividends. So you have to do it yourself. So instead of buying one, I bought a couple. I think I bought 3 of them. So I've added a few more to the stockpile. But they're like clockwork. 20%. It's not a huge chunk of the portfolio. I know it's a fifth, but as you said, I'd imagine maybe 5, 6, 7% maybe might be. So I'm not too concerned going forward. I think they're okay. So I'm happy enough to buy them as well. Sub 50 would be nice. Under 50 would be nice. So I'm afraid we've got to that time of the show again. It's the end. It's gone super fast again. Always has. John, it's been a pleasure having you. I've chatted to you a few times on Twitter. I love chatting with you. Chatted to you during the week as well, and it's a pleasure to have you here. Hope to have you on again, and I hope it went okay for you.
Yeah, no, definitely. I thoroughly enjoyed it. Thanks, guys.
Brilliant. And to all our listeners, again, thanks very much for tuning in. We do appreciate all the comments, all the views, and all the interaction. It really does help us. It's helping me so much, and coming out of my comfort zone. So we do appreciate it. And if you haven't done it already, please hit that like button, hit the subscribe button, and tune in again for more next week. See you all later.